Welcome back to Investing Talk podcast.
Today we're looking at a major player in the AI infrastructure space, the company providing the hardware backbone for the entire AI revolution.
Right.
The big question we're tackling for you is it a good time to buy this stock now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of the sources you shared.
Yeah.
The core investment puzzle here really revolves around growth. I mean, growth that most analysts would just call explosive.
Right. Explosive growth.
But coupled with that, there's this fundamental question about, well, scalability, right?
Yeah.
And profitability.
Okay, so let's unpack that growth first.
Yeah.
Because the fundamentals supporting the bullish case are genuinely staggering.
You really are.
Our sources confirm that this company's fiscal year 2025 revenue hit $21.97 billion.
$21.97 billion.
That is not just a beat. That's a massive 46.6% increase year over year.
Huge increase.
From the $14.99 billion they brought in the year prior. That isn't just riding a cycle. That's leading it.
It is absolutely leading the cycle. And here's the key thing, the key differentiator that makes this growth so relevant.
Okay.
Over 70% of those Q4 FY 2025 sales were attributed specifically to AI infrastructure solutions.
70%? Wow.
Yeah. This isn't, legacy server replacement. This is pure AI build-out demand.
Right.
This level of specialization, it puts them right at the epicenter of where the money is flowing in tech right now.
At the absolute heart of it. And if we look ahead, the management guidance is shockingly bullish.
It really is.
They are projecting at least $33 billion in revenue for FY 2026.
$33 billion minimum.
That is an enormous jump. But this is where I need to maybe apply some skepticism based on the sources.
Okay.
While revenue is soaring toward that $33 billion target, we are seeing their profit margins moderate a bit.
Yeah, that's true.
The net income for the trailing 12 months stands at $1.05 billion. Now, that number feels kind of small next to $22 billion in revenue.
It does seem small relatively, yeah.
Why the contraction? What's going on there?
This is perhaps the most fascinating financial nuance in the sources, and it really addresses the high level of execution risk they're taking on.
Execution risk, okay.
The margin contraction isn't a sign that they're losing pricing power or anything like that.
Right.
It's a direct consequence of strategic aggressive scaling.
Strategic scaling. How so?
Well, think about what goes into meeting that massive demand. They aren't waiting around for cheap overseas freight. No.
Mm-hmm.
They are using expedited shipping to meet client deadlines.
Which costs more, obviously.
Exactly. Raises costs immediately. They are rapidly hiring, ramping up labor production lines.
All expensive up front.
Very. And they're buying specialized components, sometimes at premium prices, just to ensure lead times are met for these hyperscalers who needed the product, like yesterday.
Okay, so in essence, they are choosing to tolerate lower immediate margins, that $1.05 billion TTM income figure.
Yeah.
Because the priority is capturing that long-term market share now, while the AI build-out is, well, white hot.
Precisely. That's the calculation. They are investing heavily in capacity expansion and speed.
Right.
Management's thinking is that sacrificing a few percentage points of margin today to lock in major multi-year contracts with the leading cloud providers, that's worth it.
Okay.
It's an investment in future volume and, importantly, sticky, predictable revenue streams. It's not a failure of operational efficiency.
That really reframes the financial picture quite dramatically. Mm-hmm. And regarding their ability to fund this aggressive scaling, the balance sheet looks robust enough. It can handle the stress.
It seems so.
We aren't seeing signs of financial strain that would jeopardize that $33 billion guide.
No, the balance sheet remains a significant strength here. They maintain a net cash position.
Meaning cash exceeds debt.
Right. Their cash reserves exceed their total debt,
Mm-hmm.
and they have very low leverage overall. This is vital.
Why vital?
Well, unlike many high-growth companies that might fund this kind of expansion by, say, diluting shareholders or taking on high-interest debt,
right.
The sources confirm they are generating strong operating cash flow. They're using that internal cash to fund R&D and the capital expenditure for expansion.
So self-funding the growth?
Largely, yes. Liquidity is solid, which provides a necessary buffer against any, temporary market softness or hiccups.
Okay, so that covers the financial strength. Let's pivot to the competitive edge. Because just having cash and massive demand isn't enough to guarantee success long term.
Absolutely not.
Why is this company winning against, the established legacy server makers?
It seems to come down to a few key factors:
Mm.
specialization, speed, and efficiency.
Okay.
They have sector dominance in these AI server platforms because they are incredibly agile. They aren't tied down by massive, slow-moving legacy supply chains.
More nimble.
Exactly. This lets them quickly integrate the newest, most sought-after technologies, like NVIDIA's latest Blackwell architecture.
Ah, the cutting edge stuff.
Right. This first-to-market advantage with the top-tier high-performance computing,
Mm.
it creates significant barriers to entry. Competitors simply can't match their turnaround time on these cutting-edge platforms.
And here's where it gets really interesting regarding the product innovation, which is sort of the operational proof point of that agility you mentioned.
Mhm.
Our sources specifically highlighted the new 6U20-node microblade. It's powered by AMD's EPYC 4005 series. Now, to the average investor, that might sound like, dry technical specs.
Just alphabet soup, yeah.
But what does it actually do for a major cloud client? What's the benefit?
Okay, so it solves their biggest operational headaches: space and power.
Space and power, the big ones in data centers?
The huge ones. The microblade is designed for just unmatched density,
Meaning?
meaning a hyperscaler can squeeze far more compute power into the same physical footprint.
Saving on real estate, construction.
Millions in those costs,
Yeah.
potentially.
Yeah.
But the truly critical element here is the energy efficiency. Our sources noted they use these 96% titanium power supplies and advanced cooling techniques.
Now, wait, 96% efficiency. That sounds marginal, maybe. But in the context of a huge data center, what does that 4% difference really translate into?
It translates directly into OPEX savings. Big OPEX savings.
Okay.
I mean, think about it. You're running, say, 1,000 racks of these AI servers, just going 24/7.
Right. Nonstop.
That reduced energy waste means, well, exponentially lower heat generation.
Which means less cooling needed.
Exactly. Lower cooling overhead. For a hyperscaler, this drastically reduces the total cost of ownership, the TCO.
The TCO.
So by offering solutions that are just fundamentally superior in density and operating cost, they secure massive customer loyalty.
Stickiness.
They're essentially making their customers more profitable.
That's a great way to put it, yes.
And that stickiness seems to be manifesting in their sales pipeline, which the sources confirmed.
It does. We're seeing they partner with all the major leading hyperscalers, cloud providers. And critically, these clients are moving away from just one-off purchases.
Yeah, towards multi-year rollout commitments.
Multi-year deals.
That's the structural advantage that really underpins the whole investment thesis, I think.
How so?
These long-term, multi-year rollout cycles, they ensure predictable demand.
Yeah.
That makes that $33 billion revenue guide seem far more achievable,
Less speculative.
Right. And furthermore, these commitments often lead to higher margin follow-on sales down the line.
Upgrades, replacements.
Exactly. As those data centers inevitably upgrade, replace, expand components over time. So their revenue stream isn't just large, it's becoming increasingly resilient.
Okay, let's shift gears a bit and look at the technical picture. Fundamentals seem strong, the product innovation is there. But what does the market think? What's the press action telling us about current investor sentiment?
Well, technically, the stock is maintaining a very clear and robust uptrend. That generally indicates institutional confidence. It's been holding consistently above a key support range, that sort of $45.52 to $50.32 level.
Right, that floor.
Yeah. And the fact that it maintains that support, while recently testing highs near $66.44, it suggests there's genuine buying pressure underneath.
So are we seeing profit taking up near those highs, or is this consolidation more a sign of, smart money accumulating the stock?
The indicators seem to point overwhelmingly towards accumulation rather than distribution.
How can we tell?
Well, the stock trades comfortably above both its 50-day and 200-day simple moving averages. That's a classic sign of sustained momentum.
Okay.
And crucially, the sources show that the consolidation near that $50 support level looks indicative of institutional entry, not selling pressure.
And we can see this validated by the recent 13F filings, right?
Yeah, exactly. We can.
For those maybe unfamiliar, just briefly clarify what 13Fs tell us.
Sure. A 13F filing is basically a quarterly report that institutional investment managers think big funds, hedge funds, have to file. It discloses their equity holdings.
So we see who owns what?
Pretty much. And when we see increased positions in these 13F reports, especially from leading tech-focused funds, it confirms that sophisticated institutional investors, the so-called smart money, are increasing their exposure. They're buying more.
So it validates the long-term story.
It validates the thesis that this company is central to the AI spending cycle and that this stock is being strategically accumulated, not dumped, near these levels.
And that institutional conviction is clearly reflected in the analyst community, too, based on the sources.
It is.
The consensus rating across, 17 analysts is a strong buy.
Strong buy, yeah. With price targets extending up to $67.
$67. That implies, a potential 24% upside from recent levels?
Roughly, yes.
Yeah.
It suggests the street believes the company still has plenty of room left to grow into that big $33 billion guidance number.
Shows high conviction. But we need to watch the catalysts, right? What could trigger that next leg up?
Absolutely. Catalysts are key. The most immediate event everyone is focused on is the Q1 FY 2026 earnings report that's scheduled for November 4th, 2025.
Okay, November 4th. Expectations must be, stratospheric given the guidance.
They are very high.
What is the consensus target for that quarter?
Expectations are set at around $5.83 billion for the quarter.
$5.83 billion.
Yeah. If they beat that consensus, and critically, if they reaffirm that highly aggressive forward outlook,
yeah,
we would expect the stock to probably test those recent highs pretty quickly. The market wants proof that the scaling strategy is working and sustainable.
And beyond the earnings calendar, we have those tangible product drivers too.
Right.
The ongoing ramp up of servers integrating NVIDIA's Blackwell tech.
Huge driver.
And that new AMD high-density blade launch you mentioned, those are clear drivers. But there's also some speculative buzz floating around in the sources, some rumors.
There is, yeah. There's some unconfirmed chatter circulating about a potential strategic partnership.
Oh, with who?
A major Asian data center provider. Now, look, we absolutely cannot verify this. It's just chatter.
Understood. Purely speculative.
But if a deal of that magnitude were to actually materialize, well, that would unlock a significant new revenue stream.
And expand their footprint into key global markets.
Exactly, into high-growth markets in Asia.
Okay.
That would certainly provide a sharp, short-term catalyst if it happened.
Okay. Now we absolutely have to address the elephant in the room. The risk profile.
Always risks.
Hypergrowth always comes with hyper risk. What are the specific threats to this whole trajectory?
The first, and probably the most volatile risk right now, is execution risk.
Execution risk. We touched on this with the margins.
Exactly. We mentioned that margin contraction is due to aggressive scaling, but that scaling itself creates massive fragility.
How so?
If they run into a major supply chain bottleneck, for example, or if their quality control slips because they're hiring and training so fast, the consequences can be severe. And we actually saw a little flash of this volatility recently. Their Q1 FY 2026 guidance was actually revised lower slightly, just a bit.
Okay. And the reason?
Management cited temporary order delays.
Temporary order delays. Sounds kind of benign, but what does that imply about the operational stress they're under?
It implies they're currently operating right at their capacity limit, pushing hard.
Right on the edge.
Yeah. And in an environment where every hyperscaler is desperate for these servers, delays cause immense tension. A major delay on, say, a $500 million contract from a big hyperscaler due to maybe a shortage of one custom component or a logistics failure that could absolutely crater quarterly earnings.
And damage customer trust.
Severely damage trust, potentially threatening those sticky multi-year contracts we talked about earlier. That's the big danger.
Okay, that's a big one. That raises the second major risk you flagged, cyclical volatility.
Right, sector risk.
How exposed is the company to the overall health of the global economy and specifically the AI sector spending?
They are entirely exposed, let's be clear.
Okay.
This company is dependent on massive capital expenditure, CapEx, by data center operators and large enterprises.
The big spenders.
If a global recession hits, or even just a significant slowdown, and corporations suddenly halt or dramatically slow their AI investment plans, this company's phenomenal revenue trajectory, especially that $33 billion forecast, would be immediately threatened. Instantly.
They're not insulated from macro shifts at all.
Not at all. They are essentially selling the shovels in the AI gold rush.
Right.
And if the prospectors suddenly stop digging or dig a lot slower, their business model stalls pretty quickly.
Okay, so if we synthesize all this, the near 50% growth, the market leadership, the product advantages, and weigh that against these real measurable risks of execution failure and the cyclical exposure, what does this picture tell the listener? ultimately.
Well, it's interesting. The source material, despite acknowledging those genuine risks we just discussed,
Yeah.
assigned this company an overall bullish rating of 9 out of 10.
9 out of 10, that's very high.
It is. And that high score reflects the sheer strength of the underlying fundamentals, the growth story, and the fact that they occupy this essential hard-to-replicate role right at the epicenter of the global AI build-out cycle.
So the final decision you have to make as an investor listening to this really comes down to balancing that inherent, unavoidable risk of execution in a high-speed growth environment
Which is significant.
against the company's established leadership position. You have to decide if you are comfortable accepting that operational volatility, those potential bumps in the road, for a chance at potentially massive long-term gain in what might be the most important technological shift of our decade.